what are the hidden costs in a policy?
There are 4 types of costs in every life insurance policy, whether disclosed or not disclosed. There are cost of insurance charges. That is the 800-pound gorilla. If you were in charge of running a business and you were spending 85% of your expenses on one thing, you would focus at least 85% of your attention on that one thing to make sure that you are as efficient as possible in that area. So cost of insurance charges are 85% of the total cost equation. Premium loads, which the insurance company collects to pay commissions. Fixed administration expenses. Premium loads are a percentage of the premium paid. Fixed administration expenses are fixed at the time of policy issuance based on the face amount of the policy. Those expenses are also oftentimes used to pay a commission or an override for service kind of thing. And then cash value based fees are collected mostly on variable life insurance policies, but not only variable life insurance policies. And those either go toward insurer profitability, or they can be used to pay an assets under management fee to the advisor or advisors, as the case may be.
So this is a life insurance illustration that everyone's probably seen, right? Here's the premium. Here's the cash value at a 2% guarantee. Here's the cash value at a 4.95% guarantee. But one of the things that we want to talk about today or learn about today is, in a life insurance illustration, it's impossible to determine what the costs are, and it's impossible to determine what the performance is. And I'm going to just give you a quick example. This insurance company credits 4.95%. How do we know whether they're earning 5.95%, taking 1% to do whatever they need to do, and crediting you 4.95%, or whether they think they can earn 20% on their money, and after expenses, you net 4.95%? It's impossible to tell. And I'm going to walk you through an example really quickly. Is that okay? So what we're going to do is we're going to look at the 25th year of this illustration. And in the 25th year, can I make it bigger? In the 25th year, the cash value is $1.828 million. Everybody see that? Okay. And the previous year is $1.776 million. And this is going to come back to Barry's answer in 2 minutes. So we have $1.828 million in the 25th year. We have $1.776 in the 24th year. So let's subtract one from the other. And if we subtract 1.8 million from 1.776 million, the policy had a gain of $51,994, right? And we want to figure out what our expected gain was. Multiply 1.828 million times 4.95%. Our expected gain is $90,000. Simple math. Well, if we take our expected gain of $90,000, subtract our actual gain of $51,000, we had expected costs of $38,000. Everybody with me? Now what we're going to do is we're going to look at what Barry just spoke about. We're going to get the actual numbers that the insurance company uses. So someone just write down this really quick. 1.828 million is the cash value. We expected gains of 90,000. We expected costs of 38,000. So now we're going to look at these numbers. We're going to look at what's the premium charge that Barry just mentioned. What's the admin charge? What's the insurance charge? What's the amount credited? Okay. Now let's magically, and we talked about what's hidden. So let's talk about in this illustration what's hidden. You remember in the 25th year, somebody wrote it down. How much was the cash value? Somebody yell it out.
1.828 million.
1.828 million. And how much was 1.828 million times a 4.95% rate of return? How much did we expect to gain?
90,000.
90,000. Let's look at how much the gain how much was credited behind the scenes. $348,000.
Change your word there, Steve. It's not was credited. That's what the insurance company has to credit in the future, even though they said that they're going to only credit 5, they have to actually credit that number, which is much higher and is what I would consider to be fraud in any other segment of the financial services business.
Right, agreed. So now let's go, we did the math for you. If you have $1.828 million and you get a gain of $348,000, you're being credited with 19.07% on your policy.
You have to earn, you have to be credited. You're not being credited. You have to be credited with that 25 years from now. If you don't get it, the policy doesn't work.
Right. Even though it says 4.95%. Now I know what you're thinking. Hey, we don't really know this Zeiger guy and this Flagg guy. Maybe they just chose one aberration year. Let's look at the 30th year. The cash value is $2.030 million. And as Barry said, you need to be credited $580,000. Who's good at math? What's a $580,000 credit on a $2 million cash value?
25+%.
25+%. So now, and we're not here to talk about whether they can credit 25 or whether they can't credit 25. We're here to simply say the client and their advisor, and probably the insurance broker, thinks that 4.95% is the magic number that they need to be credited to make this work. When in actuality, as you just saw, it's 19 or 25%, right? So part of the work that Barry does, that Veralytic does, is help bring this to light.
Yeah, by the way, you don't have to become a Veralytic customer the way Steve is, or the way the other gentleman Skip mentioned is. But I know many of you mentioned in the chat box that you work with insurance marketing organizations, certain insurance marketing organizations, certain brokerages. If you are not getting this information, given what insurance companies are allowed to do, and Steve's right, even the brokerage companies don't necessarily know this. If you're not getting year by year detailed disclosure of costs and performance requirements, you can't possibly be satisfying your fiduciary duties. You can't. Fiduciary duties involve justifying costs, setting reasonable performance expectations, and assessing risk relative to client risk tolerance. Those are basic tenets of fiduciary principles. If you don't get that page, you can't be doing that, or whoever you're relying on can't be doing it for you.